Hey there, and thanks for joining Talk ETFs, ETF.com's weekly video series. I'm Sumit Roy, and I'm Senior Analyst here at ETF.com. Today, I'm joined by Jeff Bowman, who's the Director of Investment Product at Fidelity. I want to start off by asking you about the massive increase in assets for active ETFs that we've seen this year. What's caused this huge increase?
Great question. Thanks so much for asking. Maybe just to take a small step back, I want to hit on what an ETF is, and really it's just a diversified way for folks to gain access to a number of investments with very specific investment exposure. And if you think about ETFs over the last 30 years, historically they've been designed to track a benchmark or an index similar to the S&P 500. But as of late, like you mentioned, we've seen a lot of growth in active ETFs. And active ETFs are a little bit different in the sense that the portfolio manager is not bound to the index. They don't have to track it quite as closely. And in fact, we've seen active ETF assets reach $400 billion in assets under management, which is up over $100 billion since last year. And active ETF assets are growing at a faster rate than their index counterparts. Really, what's driving this is three different drivers, all of which are related to client demand. And what we're seeing is that one, active ETFs help clients meet their investment goals. And that's in part driven by the ability for active ETFs to outperform their benchmark, providing the ability to have excess returns. Second, we also see that active ETFs oftentimes provide differentiated exposure. So while there's a number of active equity and fixed income ETFs, there's also examples of thematic strategies, say disruption in finance, for example, where having a portfolio manager choose the underlying investments may make more sense than using a passive vehicle. And finally, there's a number of benefits to the ETF vehicle that, when combined with active management, can be really supportive for our clients looking to reach their goals.
That's great. So, Jeff, you just outlined some big advantages of active ETFs. But as you know, for a long time, ETFs were synonymous with index investing. And a lot of people who buy ETFs are used to buying index-based funds. Could you talk about why these investors should consider active ETFs? What benefits could active ETFs provide them?
What we see is there's three main benefits to active ETFs. First is the access to investment research. Second is increased flexibility. And third is greater value. So going on the first one, access to research, again, the ability for the portfolio manager, who is someone who's closely monitoring the markets, which can often be complex and fast moving, to make adjustments to the portfolio and be proactive, leads for the potential for enhanced excess returns over the long run. Second, on flexibility, active ETFs, similar to stocks, trade throughout the day. So individuals have more flexibility when they decide to buy or sell the active ETF. And finally, relative to their mutual fund counterparts, we see that active ETFs tend to be less expensive and more tax efficient, which is only a boon for end investors.
That's some great color. Now, Jeff, I know Fidelity has a number of active ETFs on the market today. Could you tell us what your lineup of active ETFs looks like?
Yeah, we're really excited about our active ETF lineup. Fidelity's history is really in active management. We've been offering active mutual funds for over 77 years. But at the same time, we listen to our clients, we understand what their preferences are, and their needs have evolved. And as a result, we've met their needs by offering active ETFs. We currently offer a robust lineup of active ETFs across equity, fixed income, and thematic strategies, spanning different asset classes, investment styles as well. We offer 21 active equity ETFs and 10 active fixed income ETFs, all of which rely on that Fidelity history and heritage of active management. Again, with that active management, we have decades of experience across market conditions, and the investment teams bring a variety of perspectives as well to help clients reach their goals. Additionally, the advent of technology has allowed the teams to become a lot more efficient. And in fact, we're really excited that in November, we converted 6 mutual funds to ETFs. So these are our enhanced ETFs, which are designed to be core building blocks for investor portfolios. They're benchmark aware, but still offer the potential for outperformance. The way they do that is through a systematic process, which identifies companies with attractive characteristics that the portfolio management team believes is going to help outperform over time. These strategies were run for 15 years as mutual funds. They have a really strong track record. And we now believe that in an ETF, we're going to get all those benefits, the cost and the trading flexibility that we talked about earlier for our clients. overall, our active ETFs leverage insights from our investment professionals, and we're really committed to providing value to our clients in the form of active ETFs.
Finally, Jeff, before I let you go, where can investors go to learn more about Fidelity's active ETFs?
Great question. We have a lot of great resources for investors. Fidelity.com/active ETFs is a great place to start. We have a number of resources and tools for folks to learn more about our active ETFs. And as always, they can reach out to a Fidelity representative to learn more.
Fantastic. Well, we're going to have to leave it there. Jeff, thanks so much for taking the time to share your insights with us.
Thank you for having me.